Why Media Group? The fastest growing media group in North America.
Hello and welcome to Why Media Newsroom. I'm Ramona Singh, and it's always so great to spend this time with you. We have the latest development on the CUSMA. Well, it didn't get renewed on July 1st, and we have the latest on what's happening between United States, Israel, and Iran as it forges its way for the peace deal. And the US job numbers are out today, so we're going to cover that as well as a lot of FIFA news. Okay, so as we have been waiting, the countdown to the July 1st Canada Day. So happy Canada Day for everyone in Canada as we've celebrated. And yet we held our breaths to a degree to find out what the US will do when it comes to the CUSMA renewal. That would have essentially renewed it till 2036. And the business community could have just had a sigh of relief. Unions would have had a sigh of relief, and all of Canada, which depends on the United States as its biggest customer. 75% of Canadian exports go to the United States, 90% of Canadian oil goes to the United States. So the United States is a very big customer that you cannot ignore. And the, weeks leading up to it, even months, we're looking at all the signs from our prime minister in terms of will there be a renewal? Will all three countries agree to extending this CUSMA agreement, or as you would call it, the USMCA, or CUSMA here in Canada? It's the trilateral agreement between Canada, United States, and Mexico. Well, July 1st came and went, and the United States decided not to renew CUSMA in its current form. So, what this means is that the trade deal is not dead. So, that's not the issue. What the issue is much larger than that in terms of what we are to expect. And that's what we'll cover today in quite detail. So essentially, CUSMA still remains in force. And that means Canada, the United States, and Mexico move now into what will be an annual review over the next 10 years. So essentially, if all three countries eventually agree, the pact can still be extended. So even though the July 1st deadline has now come and gone, there's still time to be able to extend it till 2036. If not, then this pact will expire in 2036. So essentially, just a bit of background of what CUSMA is, or the USMCA. It came into effect on July 1st of 2020. It replaced NAFTA. It includes a 6-year review clause. So essentially, given that it was July 2020 when it came to effect, July 1st, 2026 is the review period. Now, all three countries had to decide whether to extend the agreement for another 16 years. So now the Trump administration declined to do that, saying that the current deal has shortcomings and that the United States wants to address the trade deficits with Canada and Mexico. And now this means that the deal is now enters into what would be a rolling review period. And when it's rolling, that gets a bit scary for the business sector, right? Because when it comes to business planning in terms of how much you're budgeting, in terms of investing in your business, when it comes to your overhead, whether it be in products and goods and the facility overhead in terms of hiring and staff and training. And if you're not sure if your industry is going to be subject to tariffs, which is essentially a tax, then you're not sure about what your prices are going to be. And that changes the entire model because you need to have expectations of what your budget is, what will your profits be for, when you have decided your sale numbers. And so now sale price numbers. And so this is a massive issue for Canada, right? So this means that now this rolling period is this annual review period where a lot of things could change. And it also gives a lot of more bargaining power to the United States, who essentially has really signaled on some of the things that they want to change in this agreement. Now, this agreement does continue, but the uncertainty remains for industries like the auto sector, agriculture, steel, aluminum, energy, and manufacturing. So even though Mexico says it wants to address U.S. concerns, you have Canada and Mexico are expected to keep negotiating to avoid any long-term instability. It was the two countries, it was Canada and Mexico, that did send the official letter that they do plan on renewing it. But the United States declined to send the formal letter that they also plan on renewing CUSMA during this review period. This deadline was really July 1st. Now, the danger is not on, what would be perceived as an overnight collapse because July 1st came and went. And so there's no collapse, but the danger really is in the uncertainty. So when you have companies, they may delay investments. Factories may rethink supply chains, and sectors that are tied to what would be a cross-border trade could face job losses if tariffs or rules of the origin of the market access rules change. We know that President Trump has said many things, right? In the time he's taken office for his second term, he said, we don't need Canadian lumber, we don't need Canadian steel, we don't need Canadian aluminum, we don't need Canadians to make our automobiles. And he's said those things. And so those are definitely the industries that are going to be highly impacted because they rely on our southern border partner and essentially one of our biggest customers. So now the Trump administration has declined to give the written confirmation needed to renew USMCA or CUSMA for the 16-year term. So under Article 34.7, the agreement was designed to last 16 years from its July 1st, 2020 start date. That means that it should have expired on July 1st, 2036. So unless all three countries agree to extend it, that is going to be the case. Now that's when it's going to expire. So if it goes into this rolling annual situation, then it will expire by 2036. Now, President Trump has in about another 2.5 years in office. So a lot could change with what will be the next administration and how they view Canada as one of its trading partners. Now, because the United States did not agree to extend it by the July 1st deadline of 2026, the agreement moves into this annual joint review, right, between the three countries. And at any point during that period, all three countries can still agree in writing to extend the pact for another 16 years. So now there are two separate issues that we have to take a look at, right? So first being under the text of CUSMA itself, any country can withdraw by giving a 6-month written notice to the other parties. So that means the United States executive branch could try to start the withdrawal process by notice. That is a right that they have. And second to that, under US domestic law, whether a president can fully terminate a congressional executive trade agreement without Congress is actually legally unsettled. So here in this case, when it comes to trade agreements like NAFTA or CUSMA or USMCA, where it's implemented through acts of Congress, you have several legal scholars that argue that even if the president can withdraw internationally, the president cannot erase the domestic tariffs and custom laws Congress has passed to implement the agreement. And so without Congress, changing those laws is not possible. So that's the practical answer on do you need Congress to be able to terminate CUSMA. Now, on the axis of the refusal to renew, no congressional vote is clearly required because the executive branch could send a letter that they intend on withdrawing and give that 6-month notice. Now, there will be a lot of legal challenges, of course, within the country. And as if you've seen the activity take place, you have a lot of the Canadian premiers actually do trade agreements with states, going over to the States and doing agreements like lately, Ontario did a trade agreement with Utah, right? So the premiers working with the governors to do these trade agreements shy of what would be the national one. So essentially, the president may try within this 6-month notice to give the notice to withdraw, but there will be legal challenges that will potentially happen. So now to repeal or rewrite the US domestic implementation laws, that is something that Congress would likely need to act on. And so if the question remains, if it's not dissolved what happens next, right? So the deal continues as is, and the goods that qualify under CUSMA rules still should still receive the preferential tariff treatment, as 90% of the exports, Canadian exports that go to the United States, are covered under CUSMA in terms of that free trade agreement. And so companies continue existing and using the existing rules, of course, for sectors that highly rely on it, like the automotive industry, agriculture, energy, manufacturing, digital trade, and there is a dispute settlement process in it. But what is the risk here is that this annual review now becomes the pressure point, right? What to expect, because the United States can use each review period to demand changes, massive changes, including tougher rules of origin, of more US content in automobiles, industrial goods, and limits on what could be, as President Trump has indicated, Chinese input entering through Canada or Mexico, right? He has warned heavily on Chinese vehicles, in this case, electric vehicles, getting access to the US market through Canada and Canada's trade agreement with China and what would be with the brand BYD. There's going to be 20 dealerships that will open up in Canada. There is a limit to how many will come to Canada, which is that hot mic minute that you saw at the G7 with the Prime Minister leaning over to President Trump to really tell him, listen, there's a cap on it. But essentially, President Trump has said, yeah, we don't want that to come into our market and compete with our auto sector, right? With the Ford and Jeep and Chrysler and all the different brands that the American auto sector produces. So this is also part of that, right? That could be a pressure point on annual reviews. And so any changes, like for example, the president has also talked about wanting to have more access to the Canadian dairy industry. And then he's talked about stronger labor enforcements in Mexico. So if three countries reach the agreement, they could extend CUSMA. But if they do not, the agreement continues drifting towards the expiry in 2036, and every annual period, you could have the US administration really have certain pain points that Canada would have to either agree on, negotiate on, put their terms forward, but this creates a lot of unpredictability because the US says it wants a better deal before committing to a long-term renewal. And the Trump administration has argued that CUSMA was not sufficiently reduced the US trade deficits with Canada, Mexico, and has not done enough to bring manufacturing back to the United States. Well, the trade deficit there that exists with the United States is because they take 90% of Canadian oil. There's a pipeline from Alberta that goes south to the United States to the refineries. So it would be really hard to have a trade surplus given that they take 90% of Canadian oil, and we're not talking about switching off the pipes. So you have to take that into consideration that it's not just in a black and white situation where, Canada, there's a trade deficit with Canada, and that is really the reason. So now the other items that the United States has complained about is Canadian dairy access, digital policy, energy issues, as well as tariffs that are perceived to be barriers to US products. And when it comes to Mexico, there's labor enforcement issues that the president has talked about, investment rules, corn policy, as well as Chinese goods that have been entering North America through Mexico and what would be industrial supply chains. So now, when it comes to the auto and manufacturing sector, Washington wants more US content and stricter origin rules so companies cannot qualify for a tariff-free treatment while relying heavily on foreign inputs, is what the administration has said. Essentially, when it comes to politically, this is also what fits President Trump's broader trade strategy, which is to keep leverage, avoid locking in long-term commitments, and force Canada and Mexico back to the table. And by passing the July 1st deadline for the review period, this is exactly what is going to happen. So that is where things are at. And when it comes to job losses, it could become possible, yes, because there's a lot of uncertainty that causes investment delays. And if the US imposes new tariffs or forces major rules changes, then the sectors that will be most exposed will be the auto and auto parts sector, which is huge in Ontario. So this is the biggest risk. We saw that take place as soon as he put the tariff, if you recall, the 25% tariff on the auto sector. We saw plants shutting down. We saw them closing their doors. And that is something that, it could potentially happen. These are things that we have to be mindful of. And so the North American vehicle production highly relies on parts crossing the border multiple times before an automobile is made. So if rules of origin become stricter, or tariffs rise, that means costs will go up. And that can hit plants in Ontario, in Michigan, Ohio, Mexico, and the broader supply chain, and probably definitely impact what the output will be in terms of access to brand new models that are American vehicles. And then the other industry is the steel and aluminum industry. These sectors are already sensitive to US tariff threats. Any new restrictions could affect Canadian producers and downstream manufacturers. And when it comes to agriculture and food processing, you have dairy, corn, meat, grains, and processed foods that could become a bargaining chip for these annual review periods. And when it comes to energy, you have Canada's oil and gas, electricity, and critical minerals exports that are deeply tied to the United States market. And when it comes to logistics and transportations, we're talking about trucking, rail, warehousing, and ports depend on a predictable cross-border trade. Without knowing what that's like, that puts the entire all those industries in jeopardy. So now the biggest employment risk is not mass layoffs tomorrow, but it is what would be a slower erosion where you'd have fewer new plants, delays in expansions, lowering in hiring, and what would be a gradual relocation of investment. And that also impacts foreign investment coming to Canada. So this is where things are at right now that we go into this rolling period. And Canada and the United States could try to fall back on an older Canada-US free trade agreement as a possible outcome, but through legal and political questions would arise if CUSMA is challenged and President Trump gives it 6-month notice. Now, he hasn't done so far yet. He is still in office for another 2.5 years, so a lot could happen from now until then. And this is something that we're watching as it is an evolving story to see what it means for Canada as the US could negotiate. There's also talks that US could negotiate separate bilateral deals with Canada and Mexico and not be in a trilateral deal. This is a $1.3 trillion trilateral agreement. It is massive, about 3.2 to 3.5 billion dollars cross the US Canada border every 24 hours. So this is what's at jeopardy, right? The 1.3 billion trillion with a T trillion dollars is at jeopardy because of this CUSMA deadline, renewal deadline that's come and now gone. And this is what we'll be watching for to see what will be the implications for Canada, as it is in a serious risk because the US is Canada's largest trading partner. The biggest concern is business confidence, really, right? And if companies believe that market access could change every year, they may hesitate before investing in Canadian plants, energy projects, or export heavy operations. And so Canada's negotiation priorities will likely be to protect tariff-free access. That is key above all, regardless of Canada having new trading partners and trying to bolster its existing trading partners. Prime Minister Mark Carney has taken many trips since he came into office last year and tried to bring its trading back up with China to a higher level. We have the Canada-India trade pact coming up. We have, with the UK, the EU, Australia, Japan, and so many other countries, but The big focus here is that's why we have a US-Canada Trade Minister, Dominic LeBlanc, just focused on the file between the two countries because it's a massive one, right? You can't ignore it. 75% of our exports go there. It is a $1.3 trillion trade agreement. So this is why it's critical that now Canada needs to focus on protecting its tariff-free access, keep the agreement trilateral, not split it into a US Mexico and a US Canada deal, because then a lot of things could change. The protection is really having these three countries together. It would defend auto jobs, it would defend manufacturing supply chains, and resolve, the disputes around dairy, as well as what would be the digital irritants. If you recall, just weeks ago, the CRTC wanted to add a new tax on streaming companies for Canadian content. And that was an irritant to the Trump administration, and therefore the Prime Minister told CRTC to withdraw. And Ottawa decided to invest about $600 million, for Canadian content producers. And so there you have some of the digital irritants that have been in place or that were going to be introduced. And essentially, Canada wants to avoid a broad US tariff war completely. What we saw take place early on when President Trump was sworn into his second term, if you recall, he did the sweeping tariffs on Canada, and then you had former Prime Minister Justin Trudeau announce, retaliation tariffs. And so that's the situation we don't want to go back into, because it just wouldn't end well. We're in a deficit in terms of, we have to rely on our biggest customer to be able to purchase from us. And even though, we can't, it's very hard to use the oil and gas sector as leverage because infrastructurally there's pipelines, right? That's not something that could be done. And we rely on that revenue. But all the other sectors, it's very critical when it comes to, the auto manufacturing, all the other ones that we've discussed so far. But then there's also the critical minerals, and then there's also the defense cooperation as what we've seen be the case, where Canada's now heavily decided to invest and increase its defense spending to meet the 2% of GDP target as a NATO country. And Prime Minister Mark Carney has said that he's going to go over to the 4% of GDP by 2030. That's around the corner. And part of that was a lot of the defense spending went to the United States. And now Canada is looking at a national strategy as well as having new partners in Europe and elsewhere for its defense spending. And so that's also been somewhat of an irritant when it comes to F-35s and the purchase of them from the United States side. So now, if trade friction grows, you have, consumers could eventually see higher prices on vehicles, on groceries, building materials, appliances, and imported goods, and also for the Americans, right? Because they're the ones who will see the higher prices exposed in America, as they take Canadian goods. So now tariffs are usually paid by the importers, but the costs often get passed down through the supply chains, right? So if there's a tariff on some of those industries, then yes, the Americans will pay more as they import Canadian goods, but then they may import less of Canadian goods. And then therefore the chain reaction of supply, productivity, output, overhead, staffing, all of that would be in jeopardy. There is also, Canadian currency is worth less than the American currency. That could hedge some of that when it comes to the tariffs, but overall, it is a disruption on predictability, planning, especially this whole rolling annually. Like most businesses don't want to plan for just a year. They want to plan for like 3, 5, 10 years. And when you have a rolling, sort of agreement that you have to negotiate, then it's very difficult if that rolls every 12 months. And we know President Trump does announce tariffs without like anytime he feels like it. Anytime there's a press conference, if a reporter asks him a question on Canada, he could just announce something on the spot. So there is that as well. So it's not just you have the predictability for at least a year and then you go through the rolling negotiations annually. Anything could happen throughout that year. So even without tariffs, the uncertainty can raise prices. We saw that happen. Like if you recall, the conflict with, well, the highest level of the conflict was the war with US, Israel, and Iran, and what took place in the Strait of Hormuz. As soon as those headlines that escalations were occurring, you saw the markets react and crude oil went up 5% easily, right? So that also can happen when it comes to uncertainty, can also raise prices because essentially you don't want to sell something below your cost. You have to raise it just to be able to have a protection level to based on what could come up, based on the press conferences the president gives, any announcement that could be made at any point without any level of predictability on impact on your specific industry, right? So you have prices that could rise through higher compliance cost also, just to be able to figure out from a legal perspective, does your industry fall into the tariffs? What are some of the implications? Is it covered under CUSMA? All of that is compliance costs, right? There's legal costs, there's insurance that needs to be taken into consideration. And then inventory will change because you need to understand like how much are you pre-purchasing something? Can you afford to fork up upfront to purchase inventory when you don't know what you can sell it at? And if that price will change because of taxation, the tariff will go on it. And that definitely changes supply chains completely because do you search for other vendors? And also, what is the time period to find new customers, right? One thing is you relied on your American customers. Now you have to diversify to perhaps Europe or elsewhere. And what does that look like? What does that timeline look like? And also, what are your shipping costs to Europe or to Asia on your goods? And so there's a lot of things to take into consideration which affects, the supply chain and distribution models. And so that is essentially where things are at. So even though the US did not agree to renew it for CUSMA for another 16 years, the annual review period begins now. And the agreement can still be extended if all three countries agree. And perhaps that happens during President Trump's terms. Perhaps it happens with the next president's terms, but this is going to be a rocky road from now until the President Trump's time in office is done. That's 2.5 years. And so this is something that businesses have to take into consideration. And when I say businesses, it's also families that have to take things into consideration for the next little while and what that means. So now, just a reminder, you have the formal withdrawal requires a 6-month notice under the agreement. Canada is not looking to do a formal withdrawal because they have put a formal request to renew this agreement for 16 years. Same with Mexico. The US has not put in a formal request to withdraw from the agreement, but they also did not agree to renew it by the deadline of July 1st, 2026. Now, the president's ability to fully terminate domestic implementations without Congress remains a legal dispute that will take place in their country, and whether President Trump will use the review process as leverage or actually try to withdraw, that is to be seen. Leverage for sure, because he's already signaled that he wants more leverage. He doesn't think this is a good enough agreement, even though it was done during his first term. But in terms of withdrawal, there's no signs of that just yet. Whether Canada will be negotiated with what would be in a trilateral deal, that's going to be a pressure separately because Canada does not want to have separate agreements with Mexico and a separate one with the United States and be out of this three country agreement, this trilateral agreement. And that is all to be seen. So when it comes to the trade deal, it did not collapse. So it didn't expire or collapse. It just went into what would be a controlled escalation period. And the US, because it's chosen the uncertainty as leverage, that is leverage, right? When Canada's uncertain about its future, with its biggest customer and businesses are unaware of what's to come and unions don't know, then that is leverage on its own. And in that case, you have Canada and Mexico now have to negotiate under pressure, right? And while trying to reassure their businesses in their own countries that North American trade remains stable. So there is a balancing act where Ottawa is going to have to give assurances to businesses. And also, what is Ottawa going to do if there's going to be any bailout? Hopefully not. Hopefully that won't be the situation, but it is something that it has to definitely consider. And at the same time, try to maintain some sort of leverage while dealing with the United States, but it also cannot afford to have the president give it 6 months notice of withdrawal as well. So the risk is even if the agreement survives, years of rolling review is what weakens investment dollars, confidence, and makes companies less willing to build long-term supply chains in Canada. So for Canada, the strategy should be firm but practical. You have to protect, obviously, market access, reduce any irritants where possible with the United States without having to give up so much of your rights, right, when it comes to unions and workers' rights and to be able to still protect those industries. But I think the main thing here is, Canada has to build alliances um, aside from what it's doing internationally, but when it comes to US governors. So now the premiers really need to get out there more and more and do their trade agreements. And that is really a big part of this as industries depend on Canada and how it functions on these stages. And so to avoid letting any issues come purely between President Trump and Prime Minister Carney, then really it falls onto the territories and the provinces to do those trade agreements with the governors, as well as balancing in terms of protecting its industries. We're going to take a quick break and we'll be right back.